All of you should know right now that interest rates are the highest they've been in a long time. In fact, mortgage rates have soared to their highest levels in 21 years, and what's crazy is the national average for a 30-year fixed rate loan is currently 7.6%. This means if you go to purchase a home and get a loan for 30 years, you're going to be paying 7.6% interest on whatever amount you get, and that is really high compared to previous times. Not just that, but home prices are 44% higher than the pre-pandemic levels, with the average mortgage payments being up 60% in the last 2 years. And even with all of those factors, there are nearly 40% fewer homes for sale than before the pandemic. Now, if you're confused on any terms or what exactly that means, don't worry, because I'm going to be breaking down each topic in the most simplest terms that I can. So let's start off with a real world example by saying you want to buy a $500,000 house with a 30-year fixed rate mortgage and plan to put 20% down. Now, normally with real estate, you're going to put anywhere from 3.5% to 20% down, and that is the amount of money that you are going to need up front to get the house. And if you're someone looking to get into the business aspect of real estate, the sponsor of this video, Tailor Brands, can help you out, but more on that later. So back to the example, 20% down means that you need $100,000 up front if the price of the house is $500,000. After that, you would need a way of getting $400,000, and that's why I'm mentioning a 30-year fixed rate loan. Now, currently, the national average interest rate for a 30-year mortgage is 7.6%, which is really high compared to previous times. That would mean for that $500,000 house that your principal and interest payments you would be making toward your loan would be roughly $2,800 a month. You can also add in property taxes, homeowners insurance, and other expenses, but I'm going to be covering that later in the video, but for right now, just disregard that. Now, if you really want to know why I'm disregarding that, it's because it varies on location. For example, if you got home insurance in Vermont, it would be $800 per year, where Florida is triple that at $2,400. But back to the 30-year loan, with payments being $2,800 per month, that's going to result in paying $34,000 per year. Not just that, but if you kept this rate and paid it off consistently for 30 years, that means that you would have paid over $1 million from a loan worth $400,000. Now, if this were 2021 instead, the national average 30-year mortgage rate was 2.96%, which if you had this rate instead for that same $500,000 house, a monthly expense of principal and interest payments would only have been $1,600. After a full year, that equates to $20,000, and not trying to show off some of my engineering skills, but that's $14,000 less than today's current option. Now, if you kept that rate and paid it off consistently over 30 years, that means that you would have paid $600,000 instead of $1 million. That means that the total interest you would have paid would have been $204,000 exactly, compared to $618,000 with the example before, which is over a $400,000 difference. So the difference between buying a $500,000 house today with the current rates compared to 2021's average, which is only 2 years ago, the difference would have been $400,000 over a 30-year period, assuming you didn't refinance the house at all. Just think about that. Because interest rates have risen so much in the past 2 years, someone who bought a house 2 years ago is spending $1,400,000 less on payments solely because of the time they got in. Now, I know that data was based shortly after the pandemic, but I also want to just mention again that houses are 45% higher right now than right before the pandemic in 2020. So if you also factor in the rise in home prices, your $500,000 house would not be nearly as close to the same value as it would have been a couple of years ago. But with that being said, let's talk about the expenses that come with buying a home and what you need to factor in ahead of buying. Now, before we go into the details on how much homes cost, if you appreciate the research that has gone into this content, I'd really appreciate you hitting the like button below. With that being said, I'm going to start off with a rate comparison showing you how much interest rates have actually changed over the past couple of years. So this is obviously more complicated than just renting a place, so let's start off with a mortgage. This is basically you going to get a loan from a lender that could be a time period of 15 or 30 years, and by the end of that time, you would own the house in full. See, with a mortgage, you have principal and interest that is getting paid off over time that goes toward your equity in the house. So those total up to a certain expense, and let's say that you get a 30-year fixed rate loan, your total expense for mortgage payments is going to be the same every month, where the price you pay will never change throughout the entire term. What I love about this is that over time, you will accumulate more ownership in the house as you continue to pay off your mortgage. Then the second factor to consider when buying a home is taxes. The taxes on a home are pretty much based off a percentage of the home's value and is different for pretty much every state. And just be aware that the amounts you pay are adjusted every year based on the property's value. value. In fact, the first bill I paid for property taxes on my rental in Florida was about $1,400, and then 3 years later, that became $2,600, which is an 81% increase. And then after that is going to be insurance, and lenders typically require this from you as a homeowner to have homeowner's insurance. A standard homeowner's insurance policy provides coverage to repair or replace your home and the things you may have had inside in the event of damage. The damage typically includes something like fire, theft, weather events like lightning, or even hurricanes. In 2022, we had 2 hurricanes hit Florida pretty bad, and my insurance went from $1,400 to about $4,000 the next year. Now, I was able to get that reduced to $3,300, but that's still a significant increase, so be aware of that before buying a home. Now, after insurance, another factor could be repairs and maintenance. Things that may need repairs that I've had to go through in the past couple of years could be an AC unit, fridge, additional insulation in the attic, and many more things that are not going to shock you, but they come from owning a house. Now, a popular reference for repairs and maintenance is the 1% rule. With this, you simply take 1% of the home's value, so say a $200,000 house, you would need $2,000 for repairs and maintenance every single year. Personally, when you go to buy a home, I would recommend to overestimate that number to even 2% just to be safe, because you never know truthfully. Another rule for this that's not as popular is the square foot rule, where you set aside $1 per square foot of the home. So if your home is 2,500 square feet, the rule says that you need a minimum of $2,500 for essential repairs and maintenance. And then the last expense is what I like to call miscellaneous. This pretty much consists of things that you need but are not categorized in the other sections. Examples of this include improvements, utilities, and if it's for a business purpose, an LLC. An LLC is a limited liability company that you can start and actually get protection from any of your personal assets, where you also have the ability to deduct any relevant expenses or home depreciation from your taxes legally. To do this legally, you need to build a true business, and the best way to do that is with the sponsor of this video, Tailor Brands. Now, Tailor Brands makes it easy and affordable for you to get your own LLC for any business you have. The company provides you with all the legal required services for the LLC that include a registered agent, annual compliance, an official EIN number, that is how you can separate your real estate from your personal assets. So in the worst case, something happens to someone on your property, the LLC could help so they won't sue you directly, they could go after your LLC. The company also helps with managing your taxes and bookkeeping so you can maximize your deductions when it comes to tax season. So to get started, you're going to want to click the link in the description below that will take you to this page where you can enter the state you're filing in and then your ideal business name like John Rental Avenue to see if it's available. And since this name is available, we can continue the process, and if you run into any issues at all, just try another name until there is a fit. So the first thing it's going to put you through are some questions on your stage for your business, and let's just say you've already bought a rental property, so click on business and then type in the industry, for this case real estate, then pick what best suits it. After this, you can continue on, select whether you will hire employees or not, and other inputs to get started. But this page is extremely important as you can select what you are planning to do, so we're going to add EIN, and you can see all the other products that they can provide for you, so click whatever you are interested in and click next. So from there, you'll see a few more things to fill out, and then you can preview and send this through, and the company will get back to you with further details. Make sure you get that EIN number, because that's what's going to help you set up a business bank account and keep all your business assets separate from anything personal. So besides that, other features the company offers are business documents, license and permits, business bank accounts, trademarks, websites, domains, logos, and many more if interested. So if you're interested to get started with Tailor Brands, don't forget to check out the link I have in the description below. Now, before you officially buy a home, there are a few general rules that you can follow to make sure that you can even afford it. The first being the 28% rule. This rule states that you should spend at most 28% of your monthly gross income toward your mortgage payments that include your principal, interest, taxes, and insurance. For those curious, your gross income is basically all of your income before taxes. So here's an example of how you can actually apply this rule. Let's say you make $5,000 per month. That means you multiply that number by 28%, so 0.28, and that would equate to $1,400 per month, which is the max your mortgage payment should be by following this rule. Another popular rule to follow is the 30-33 rule, which states that you should first spend no more than 30% of your gross income on a monthly mortgage, second, have 30% of the house's value saved up in cash, and third, the price of the home should be no more than 3 times your annual gross income. Alright, so with that, I'm going to show you a simple way on how you would violate this rule. Let's say you make $80,000 per year and have $100,000 in cash saved up. You really want to buy this one house that's worth $600,000. You can't put down 20%, so you put down 15%, and based on that, using the current average mortgage rate of 7.6%, which just for this example in the state of Florida, that means your total monthly payments from principal, interest, taxes, and insurance would be roughly $4,200 per month. So with $4,200 and you making $80,000 divided by 12 months, which is roughly $6,700 a month, you are violating the first rule because 4.2 divided by 6.7 is 63%, where this rule says you should have no more than 30%. You then break the second rule of 30% of the house's value in cash because $100,000 you saved up out of the $600,000 is only 17%. If you put 15% of the $600,000 as a down payment, which is $90,000, that would leave you with $10,000 in cash. Now I know that may seem shocking, but if you only had $10,000 left in cash and you lost your job or something terrible were to happen, that would be really hard for you to last more than a month or two before having nothing left and stressing yourself out. So if you had 30% of the home's value, that would be $180,000, and after a 15% down payment, you would have $90,000 left over as a much better safety net. Plus, if you had 30%, you could actually put down 20% and get a better mortgage payment out of that. So by using this rule, you already violated two of the things, and you would violate the last one as well, where your home value cannot be more than 3 times your annual gross income, which for this case, $600,000 divided by 80,000 is a 7.5 times multiplier. So by following this rule, in order to get that house that you wanted, you would need at least $180,000 saved up with a current annual gross income of $200,000, which don't forget that is if you are married and filing jointly as well. So this rule is obviously a safe approach to understand before getting yourself into a house that you may be getting too much debt on and not be able to afford. Then on the other hand, it's not like this is even guaranteed because you also need to be able to get a loan from a lender, which is a whole nother topic. So because of that, let's now talk about how much you can actually get. Now lenders mainly focus on two things, that is income and debt. The income part is mainly the lender viewing your actual income, how stable it is, and even to check your previous tax returns, usually your past year or two. So besides that, a very important thing that lenders look at is something called your debt to income ratio, which basically takes all your minimum required monthly debt payments like credit cards, student loans, auto loans, and any other personal loans, and from there it divides it by your gross monthly income. In simpler terms, it's pretty much how much money you have after all your expenses. And so most lenders like to see that ratio below 43%, although it can range slightly, but the lower it is, the more likely you are to get approved for the loan. So an example of this is, let's say that you're making right now $5,000 a month. That means that a lender would be willing to give you up to roughly $2,150 per month to use on all of your debts. That means if you have $300 in credit card debt, $400 on your car loans, $100 on student loans, then that means you can take on roughly $1,350 in debt, which if you put that into a house, you can get one that is in the range of roughly $200,000, assuming you put 20% down with the current interest rates right now. But say you pay off all your car and student loans, then that means you could get $1,850 from a lender that could instead get you close to a $300,000 home. But with an income of $5,000 a month, that is $60,000 a year. And remember earlier from the rule, that would be 5 times your income. And the one earlier said it can only be no more than 3 times. All right, so based off of how much lenders would give you, let's just assume that you have $1,000 a month in total debt. And for each option I'm going to show you, let's just assume that you have 30% saved in cash where you can put down 20%. So in order to get a $200,000 house with current rates, you would need to get roughly $1,300 for monthly debt. That means to a lender, you would need to make roughly $2,300 divided by 0.43, which is roughly $5,400 per month in order to get this house. Then in order to get a $500,000 home, that would lead you to a $3,200 monthly payment where you would need $3,200 plus $1,000 in debt that you have, which is $4,200, and divide that by 0.43. This basically means that you are going to need an income of roughly $10,000 per month to get this house. Then to get a $1 million home, you would have to have $6,400 in monthly payments that would require you to have an income of $15,000 per month. And for a $3 million home, your monthly payment would be $19,000 per month, and you would need an income of $46,000 per month, which by the way is $550,000 per year in order to get that home. Then for a $6 million home, your monthly payment would be roughly $38,000, and your income would need to be $88,000 per month, which is just over $1 million per year. Then lastly, if you want that mega $85 million home, more so mansion, your monthly payment would be roughly $536,000 per month, and you would need to have an income of $1.25 million a month, which is roughly $15 million per year. Now obviously those are all estimates and don't guarantee anything at all on what you can actually get, but it's more so a guidance on what lenders typically follow. But in all seriousness, if you're someone that just doesn't want to buy a house, you could also look into renting, and as of right now, studies show that on a national basis, owning a home costs 25% more than to rent. In fact, buying a home right now is only cheaper in 4 US cities, and that came out to be Detroit, Philadelphia, Cleveland, and Houston, which is supposedly because they didn't see a massive run-up in prices during the pandemic. And for those interested in the housing market for 2023 and even 2024, realize the rates are really the issue, and if they could be under 4%, supposedly it can make buying a house less expensive than renting in most cities. So all in all, it may be better for you to rent right now and save up until things get cheaper. And you could also work towards the goal of achieving the 28% or the 30-33 rule, because you now know what it takes to actually get the type of house that you want. It states that if you can rent a similar home for less than $1,500 per month, then renting would be the better choice. With that being said, if you found any value in this content, I'd really appreciate you subscribing to the channel and checking out future content, and even sharing this with someone you think could benefit from. And if you're interested in checking out the free guides I've created on Investing 101, 3 fund portfolios, and savings accounts, check those out in the description below. And while you're at it, don't forget to check out the sponsor of this video, that was Tailor Brands, that is linked in the description as well. And as always, don't forget to hit the like, subscribe, and notifications button for future Money Talk content like this. Thank you.